Our next session focuses on the Nedgroup Investments Core Income Fund, managed by the experienced team at Quanta Asset Managers. The fund has delivered an exceptional track record of outperforming cash benchmarks of multiple interest rate cycles. Joining me now is Keorapetse Leballo of the Quanta Asset Managers. Keo, to jump straight into it, the first half of 2026 dominated by geopolitical uncertainty, volatility, trade tensions, and of course the fear of renewed inflation pressures. What's your assessment of the current macro environment today?
Indeed, it has been dominated by an uprising in geopolitical turmoil. And in fact, shipping traffic, in particular, entering or leaving Iranian ports via the Strait of Hormuz, plummeted since the start of the second quarter. And this is of great significance because shipping traffic that is passing through the Strait of Hormuz represents approximately 20% of global oil trade. And according to the IMF's Port Watch, an average of 6 to 7 ships were recorded per day since the start of the war. But this is coming down from a pre-war average of approximately 90 ships. Now, therefore, this war has created instabilities across global energy markets through supply, oil price stability, thereby threatening some sort of reflationary risks that are cost-driven. It has been the overarching theme that we are seeing at the margin, also sipping through to the early stages of the second half of the year.
It's quite interesting. I mean, despite the headlines, if we look at sort of real-world data, they seem to suggest that the impact has been more limited than feared. What should investors take away from that?
Heightened levels of global uncertainty are going to be a permanent feature insofar as financial markets are concerned the world over. But then again, the biggest concern that we are seeing is coming from a growth point of view. And in fact, any forms of elevated input costs, such as increasing oil prices, are filtering through the economy via manufacturing output. This is clearly seen through the strong inverse relationship that exists between producer price inflation as well as manufacturing output. So suggesting that at least over the next 18 months, we can expect some form of limited output as a function of there being elevated levels of cost price pressures. So manufacturers, in the absence of there being strong consumer demand, are unlikely to pass through the same level of output to consumers at a high price. This will therefore curtail manufacturing output, at least over the near term, according to our assessment.
Okay, so in your view, what I'm hearing is there is the risk of slower growth that will come through in the next, at least foreseeable future.
100%.
Yeah, okay. And how's that feeding through to the labor market? There's been, I don't know, through the months so far yet read some conflicting data on that. How are you seeing that in the relationship between manufacturing activity and job creation?
Weaker manufacturing activity limits meaningful job creation in the economy. In the event of there being meaningful job creation in the economy, then therefore there is limited levels of income or second round inflationary pressures. More so if labor participation more than offsets nominal wage increases that are above inflation. It then points to us that there is less meaningful risks around second round inflationary effects emanating from global labor markets.
Okay, and we've touched on sort of how the labor market, has cooled over time. What effect does that typically have on the broader economy? How is that reflected in what we're seeing today? Markets are quite elevated. There is uncertainty around, I think, the path of interest rates. In the US, for instance, of as much as President Trump wants lower rates, I think the Fed has signaled, that might not be as easy, in the next few months.
When we look at the relationship, for instance, between savings as a percentage of disposable income in the United States, it's pointing to us that inflationary effects will remain broadly contained in the absence of there being resilient labor markets. In fact, the latest print in the US's NFP data is reflective of these growing concerns that we have held throughout the second quarter of the year, that these are likely to present themselves as fertile ground for there being a much more subdued outlook insofar as US inflation is concerned. And this is rather intuitive. If savings as a percentage of disposable income is negative, then that implies that in the future, consumption levels will remain broadly contained. And this should be overall supportive of the near-term policy outlook, suggesting that the aggressive path in policy rate increasing is something that perhaps is overly subscribed to insofar as financial markets are concerned. We are of the view that perhaps the forthcoming path in global interest rates is likely to be less aggressive than what is currently envisaged.
Okay, so you see, for the foreseeable future, as you mentioned, at least the US Fed and perhaps the European Central Bank will take the path of least resistance here, and they'll actually have the flexibility to actually lower rates.
Absolutely. I mean, pre the war, both the Fed and the ECB retained room to ease policy of approximately 125 basis points, respectively. At this present juncture, or coming from the war, they have since instead erred on the side of caution to say would rather maintain rates at current levels and see just how persistent are these cost push shocks likely to be over the near term before intervening through monetary policy action. And again, if this relationship between the ECB's policy rate as well as its respective core price inflation indicator were to remain contained or intact over the near term, we are likely to see some form of a flat to a marginal cutting cycle in the ECB, versus in the US, it's likely to be a bit more aggressive than what we are seeing, for instance, in the ECB. And from a South African investor point of view, that carry trade effect that the US retains in easing policy should continue to bode well for the rand as well as our domestic policy outlook.
Okay, you mentioned the rand there, so bringing it closer to home, be interested to hear, how do you see the path of local rates playing out? Intuitively, I would imagine, everything that our SARB or central banks around the world, right, they take the lead from the US Fed. So in your view, there would be a path down eventually as well for rates. We had that last year. We've had one hike so far this year. How do you see that playing out locally?
Locally, hikes are no longer, or aggressive interest rate hikes are no longer reflected in the domestic policy pricing market, such as the forward rate agreement market. And in fact, the FRAs are only anticipating that we are likely to see a 25 basis points increase in the repo rate in the second half of the year. The next 25 basis points increase is not particularly fully priced in. And in fact, there is an outside chance that towards the latter stages of the year, we might see another 25 basis points cut instead. So this is likely to present itself as one of the most shortest policy rate hiking cycles that we have ever seen in response to the ongoing geopolitical tensions that are taking place in the Middle East.
Yeah, it's quite extraordinary when you think about it. We're sort of on the verge of the largest energy shock that we've seen in living memory, yet everything seems so well contained. And I mentioned, we could even have a cut by the end of the year. I certainly look forward to that. Coming back to that, though, I do want to touch on, what's your current outlook then for SARB policy, given that we've moved to this new sort of inflation targeting dynamic, and then tied to that, what factors could cause the SARB to surprise either to the upside or the downside, in your view?
100%. The first question, the overarching view with the SARB's near-term outlook suggests a rather supportive monetary policy path, a gradual easing with a terminal repo rate over the next 12 to 18 months of roughly 6%, coming down from current levels of around 7 or maybe potentially 7.25%. following potentially this week's monetary policy outcome. So this is by and large supported, A, by that resilient currency. We saw the rand relative to oil prices maintaining its resilience via the carry trade effect of there still being attractive yields in the domestic interest rate market versus in the United States or through broader developed economies or more developed counterparts, for instance. And again, the shift in the policy objective from a 4.5% midpoint target to a 3 percentage point target and a 1% tolerance band on either side is also equally supportive post the short-run shocks in the global oil price pressures to see there being some sort of a sustained monetary policy rate reduction that could play itself out over that forecasted period of 12 to about 18 months. So A, a resilient rand. B, the shift in the lower policy target is likely to present themselves as good driving forces behind the rate path that we are expecting over the near term. What would then surprise the outlook to the upside is if we were to see a revival in the local labor market data, if we start seeing more of a robust labor market, labor absorption rates increasing surprisingly out of nowhere, these can potentially drive concerns around core CPI increasing or second round demand pool inflationary pressures beginning to come to the fore. These would then result in the SARB cautiously hiking interest rates as an attempt of curbing some of those risks.
And at the moment, are you seeing sort of any of that, showing up anywhere?
Labor markets remain particularly stretched. There's a growing number of discouraged job seekers in South Africa. If anything, investment-related activity or real gross fixed capital formation is broadly contained in South Africa. The amount of capital expenditure programs that the private sector is engaging in is rather subdued in the face of elevated global uncertainty, global geopolitical uncertainty. We don't see a lot of private sector investment expenditure taking place. Similarly, the government remains still broadly constrained from a fiscal point of view to engage in any form of notable or sizable public investment expenditure programs to therefore absorb this idling labor force. But in the absence of there being that level of investment expenditure, both from the public as well as from the private sector of the economy, then therefore I don't see any form of real second round inflationary effects emanating from demand.
With that broader market backdrop in mind, can you talk us through how the Negative Investments Core Income Fund has performed and what the track record says about the strategy over time? I mean, it's been remarkably consistent.
Correct. The Nedgroup Investments Core Income Fund has managed to deliver a consistent level of benchmark relative outperformance and resilient returns across various interest rate cycles within the region, or the outperformance has been within the region of 130 odd basis points above benchmark since inception across the various measurement periods. This has been achieved primarily through taking very limited interest rate positions, as well as selectively capturing term premium at an instrument level of up to 7 years. So we can hold instruments that have a maturity profile of up to 7 years in the portfolio, swapping out the fixed exposure for the floating rate exposure, thereby insulating the portfolio against interest rate risk across various measurement periods and interest rate cycles. So that has been the winning formula for maintaining such a consistent level of outperformance.
And what's particularly interesting about that, to me at least, is that despite the various interest rate environments that we've experienced in the last years, I mean, the key driver behind that, can you give us some insight into how it's been able to maintain that consistency, throughout the various cycles that we've experienced over the last few years?
Correct. It's very conservatively managed. We are mainly exposed, I think 98% of the fund is exposed to floating rate instruments. We hold a large quantum of bank deposits, senior bank paper, as well as RSA government issued paper. So therefore the portfolio is quite conservative. The latest GCR credit risk rating of the fund stands at AA with a stable outlook, suggesting that the fund is meticulously managed on the back of these moving geopolitical as well as interest rate risks that are coming through as a result.
You've touched on fund positioning there. Can you talk us why that's sort of appropriate in this environment, and what your outlook is, at least for the next couple of months to the end of the year?
In our conservative nature of managing these funds, ours is not to unduly expose the investor to heightened levels of risks that they may not necessarily be compensated for. Therefore, by its very design, through maintaining an attractive liquidity profile while eking out term premia in the fund, we prefer to skew the exposure of the fund to strong credit risk exposures, primarily across the big four, big five banks, as well as the SA government. So that has been one of the winning formulas for us in ensuring that we do not, in this uncertain environment, expose the fund to perhaps questionable forms of credit in the event of purely trying to chase outperformance at the risk of unduly exposing clients to heightened levels of risk that they may not be compensated for.
And with that, we'll leave it there. As we've heard now, the fund very much, appropriately positioned. The fund continuing to sweat the cash, making cash work harder for investors, and we look forward to the many healthy returns going forward in the years to come from you and the team at Quanta. Thanks so much.
Absolutely. Thank you. Thank you for having me.